Welcome back now. As 2025 approaches, global markets present an ever-changing landscape, offering a mix of opportunities and challenges. Geopolitical tensions, shifting economic policies, easing monetary policy, and global political shifts, with President-elect Donald Trump stepping into the White House in January. Taking all of this into account, how should investors be navigating markets? The head of equities at Schroders, Simon Weber, joins me with his take. Thank you so much for your time, Simon. Quite a lot of ebbs and flows, but even with that, the equity market has actually had quite a strong performance this year. Isn't it remarkable that investors can still find a level of safety in the equity market, even with those macroeconomic clouds hanging over them?
Yes, we remain pretty constructive on equities. At the end of the day, the global economy is in a reasonable expansion, a very stable expansion phase. The US economy has been stronger than many people expected. And when you bring it down to kind of the average level of corporate earnings growth, that is been getting close to double digits. And as we go into next year, still expected to be around 10% or so growth. So the outlook for earnings, which ultimately drive equities, is fairly robust.
And actually, just drilling into the US, you mentioned some of the drivers that we've got a strong economy there. But I mean, we even had Fed Chair Jerome Powell yesterday giving an address after the interest rate decision that was made. And it seems that monetary policy maybe won't be loosening as much as investors thought. Are investors kind of shrugging that off in terms of the expected continued momentum there?
Well, the reason that the Federal Reserve are not likely to be cutting interest rates as much as expected by the market before is a little bit inflation, but also that the underlying health of the consumer, investment in the economy has also been stronger than expected. So it is quite a positive message from the Fed that activity in the US continues to be strong. And at the end of the day, that's what drives the business, the revenues and the earnings for most of the companies that we can invest in.
Yeah, well, those drivers have led to quite lofty valuations in the equity market. Is there no significant fear of corrections, particularly in the tech sector? And can those valuations actually stand?
Well, corrections are hard to predict. They're always possible. But if we break down valuations, which at a headline level do look quite high for the S&P 500, the US market, excluding the tech sector and the big magnificent seven, if you like, actually valuations for the rest of the market are in line with their long run averages. So it is in these big tech companies that the valuations are higher. But these are brilliant businesses with network effects, with competitive advantage, and they are growing earnings globally, not just from the US market. So we think the health of those businesses is strong, and valuations relative to the growth of those big tech companies, that what they've been able to achieve and are likely to achieve, are also still quite reasonable.
I mean, brilliant businesses, and I mean, on some level, you can kind of justify, how high they've gone in terms of those valuations, those tech companies. Of course, we know that the big focus is artificial intelligence and investment into that. And really, one of the things that investors really drill into is the return of investment. I remember at some point, investors were quite worried about all the money that Meta was spending on the metaverse, and really the concern there is how much return then can we get? Is there any kind of concern or risk here when it comes to these companies investing in AI and the potential return that could be coming from that?
Yeah, I mean, given the tens of billions of investment going in, investors are beginning to ask more serious questions, as you say, about the return on that investment. But we are getting examples of monetization and return. Meta is actually a very good example. The tens of billions they're spending is really helping them improve the accuracy of their advertising targeting to their customer base, which gets a very direct return on that investment. We are seeing rapidly accelerating applications for AI across different businesses. In our own business of asset management, we are using it across the investment teams, multiple times every day to help us get better and more productive at our jobs. And I ask my own team what you would pay for these services, and it's actually multiples of what we're currently paying. So there are questions, but there are also huge benefits from these models and these applications, and we have to have some faith that the monetization will come.
I mean, also the gains here, particularly when you look at the S&P 500, have largely been concentrated on the tech sector. In terms of your outlook for 2025, can those gains in the equity market actually even out and diversify?
That is something that we are looking for. We expect to see the market broadening out. And that, as I said, it's not that we're negative on these big tech companies, but there are perhaps, greater, more interesting opportunities for next year in some other parts of the market and other parts of the world. I mean, perhaps the most unloved region at the moment is Europe. All sorts of political instability, the economy is slowing down. But there are great businesses in the European equity market as well. And currently they are selling at a very big discount to their US counterparts. So we can look to some other parts of the world for some interesting opportunities where there's this wall of worry, plenty of things that look negative. But often you need that wall of worry for a good investment, because as you climb it and you get over these problems, the returns can be good.
Well, let's zoom into emerging markets. What should we be looking out for there, and does cheap equal attractive?
Well, emerging markets are hugely varied. I mean, Chinese equities are a value market. There's a lot of value there, and market investors are not confident. On the other hand, you have Indian equities, which have been in a bull market for pretty much a decade. It's a very good structural growth story, but we don't believe you can put emerging markets into just one group. What we should be looking for next year, and not just for emerging markets, for the whole equity market, to what extent China can stabilize their property market. They have absolutely become more stimulatory with their monetary and fiscal policy. But investors are kind of asking whether it's enough and whether the problems are too big. So that is certainly one of the most important things to watch next year, is what is this? Can they get consumption going? Can they improve consumer confidence and stabilize the property market?
Well, thank you so much for that very insightful conversation, Simon. Much appreciated. That was Simon Weber from Schroders.